listen, we're in for a treat. We have some of the biggest players in the crypto space here. They all have been in it for a long time. They're running major organizations in the space. And we're going to talk a little bit about traditional capital flowing into the space. So we are seeing this transition from the kind of the retail base to more of an institutional capital base and more of a traditional capital base, people that have invested in equities, stocks, bonds, commodities coming into the space. And this group right here is at the forefront of it all. So I'll just do a real quick introduction of everybody. I've got right here Bobby Cho. He's Global Head of Trading there we go. He's got some fans here too. I feel the same way every time I see him. So Bobby is Global Head of Trading for Cumberland, one of the bigger over-the-counter Bitcoin traders and cryptocurrency traders. We've got Robert Dykes from Caspian. He's here representing kind of the infrastructure plays. We've got Wayne Trench from Octagon, another big player in the over-the-counter space. And then Will Peets from Passport Capital, who is here representing the institutional side of the business. So you know what, why don't I start with you, Will? Because we were talking a little bit beforehand of tell us a little bit about what you guys are doing at Passport, why you chose to structure, you have an interesting way you structured the business. What did you see from the institutional and from the traditional capital flows that you guys said, you know what, we need to structure it the way we are? So explain that to us.
Sure, thanks, Brian. So actually at the beginning of last year, maybe just briefly on Passport, we're kind of a 17-year-old long-short equity hedge fund, very macro thematic. Started first investing in blockchain just as a secular theme in our portfolio. First in more of a commingled type fund. And as many of you are probably aware, there's a lot of difficulty in investing in cryptocurrency in a regulated fund structure in the US. And so, learning from that after putting the capital to work last year, we had structured two separate vehicles to invest directly into cryptocurrency. So one is a dedicated fund that only invests in liquid currency protocol and to a lesser extent application layer projects, but everything that's traded, everything that we think to our best ability doesn't look like a security. And then a second fund, which is a kind of a hybrid fund of funds that invests in our internal fund, does direct ICO investing, and also invests in other strategies in the space. And part of the rationale there is twofold. One, we tried to segregate what's considered to be a security, so fund interests and SAFs, which helps us, we think, from a regulatory perspective. And then two, the platform is really designed to help bootstrap a global network to enable collaboration across the funds that we're invested in and really be an institutional platform to allow institutions to access the space.
And you've seen a fair amount of demand from traditional asset managers, or are we looking more like family office? Where's the demand coming from today?
Yeah, today it's still from family offices, high net worth individuals. We've, of course, talked to a lot of our traditional LPs about investing in this space, and there's a tremendous amount of interest. And they all want to take meetings, they all want to learn and be educated on it. But I still think we're probably 6 months to a year for some of these more traditional LPs in being willing to allocate to the space. I think they're also going to be very kind of compartmentalized in how they actually take exposure and invest in the space.
Perfect. Actually, I think that's a great transition to Wayne, because we talked a little bit about how there we go, it's still working. How this is, the complexion of the investor is changing. So at Octagon, you have a retail side and then a block trading side. Can you tell me how that complexion is changing? Are you seeing more retail? Are you seeing more blockchain? And what did the retail investor look like before? What does it look like today?
Yeah, I think we've definitely seen. What's that? It's working?
It is working.
Okay. Yeah, look, I think our client base has evolved over the last sort of 18 months or so. We had the business was originally born out of our retail exchange business, and then as the demand for larger ticket sizes, I guess, grew, that was primarily driven by the high net worth and ultra high net worth individuals, I guess, based in Asia. And I guess that's continued, that demand has continued, but in the last sort of 3 to 6 months, we've seen a definite pickup in institutional interest. And I think that interest has come, like I'd split the institutional demand in a couple of different ways. Obviously from the hedge fund space, we've got the more systematic trading businesses that are used to using technology to sort of navigate markets, and those systems generally like volatility. And so I think those players have probably been a little bit more advanced in the space as we see it. The more traditional long-short hedge funds, as they sort of contemplate the best way to enter this market, they're still, I guess, getting or coming to terms with things like security, risk, custody. And so the way we've seen them start to get exposure is actually through the CIOs or the founders of the fund who are looking to try and take personal positions, I guess, to get comfortable with the asset class, and actually running that flow through the fund structure, but through their PA, I guess with the view to really setting up for a more institutional play probably later this year.
Okay, and so Bobby and I have known each other for a long time. You've had many iterations, or you've seen many iterations in this. Bobby runs one of the larger over-the-counter, and you deal mainly with institutions now, is that right? And how have you seen this market change? Let's say, a year ago today to today. How has your customer base changed?
Sure. So just to give everybody a little background about Cumberland. So Cumberland is the leading liquidity provider in the cryptocurrency space. We make markets across 30 plus different cryptocurrencies, and we'll do it across different types of pairs that may not be offered on exchanges. We are a principal trading firm, so we do take risks and manage risks appropriately. But in terms of, I guess, what we've seen, I think for about the last 2 years, everybody's been asking, when's Wall Street going to get involved? When's the institutional capital kind of flood into the market? But I think what you actually saw in Q3 and Q4 of last year was that this market is still heavily dictated by retail. So you saw it happen in Japan, you saw it happen in Korea late last year. I still think, kind of how Will and Wayne had mentioned, that I think a lot of guys are still getting up to speed on what's happening in the market, educating themselves, and just figuring out exactly how to make their play and where to allocate capital appropriately.
So then I'll ask Robert, is it an infrastructure hurdle that they have to get through? Is that what you're trying to achieve or trying to address?
Well, I think it's multifaceted. I mean, obviously the infrastructure is critical. I mean, as you get institutional investors, LPs into the crypto space, they're going to require transparency, they're going to require reporting, better risk management, portfolio construction. There's a bunch of tools that an institutional investor expects from a fund that they're giving capital to. So I definitely think the technology, trading systems are critical, but I think there's also regulatory clarity that needs to happen in some of the jurisdictions like the U.S. And then the whole traditional structure between administrators, create that separation that institutional investors want. I think institutional investors aren't used to the fund custodying their own assets. They want a third party. So there's some regulatory stuff that needs to get sorted out. There's traditional structures like administrators, custodians that need to proliferate, as well as the trading technology. And I think that's starting to happen. If you look at some of the administrators that are in the space in the U.S., I think they've got backlogs of 50, 100 different funds that are trying to launch into the space.
So that's interesting. There was probably about 200 crypto hedge funds that launched last year. So you've got a pretty good target market. I'm going to ask both Wayne and Bobby about this. The typical crypto hedge fund that comes to you, are we talking $10 million, $20, $30 million trades, or are we talking $250,000 trades? What's the size of this market right now? Well, let's start with you, Wayne.
I wouldn't say that $10, $20 million trades are the norm. They do come from time to time out of that, out of that institutional type of client. But we would see bigger volumes than that come out of the high net worth or ultra high net worth client base who might trade 100, 200, 300 bucks. So I think from the crypto hedge fund perspective, it's normally probably $1 million is probably the right amount for them, or maybe a little bit lower, depending on what they're trying to do.
I mean, I'm just going to add, interestingly enough, a lot of our traditional client base that's going into the crypto space is really not about AUM. It's, they turn over the fund probably 100, 200 times. They're very much arbing different markets. So there's a lot of very trading-centric firms that are in the mix right now. And I think Will mentioned this, is on the back of that, you get the more traditional long-short that are starting to get into the space.
Yeah.
I'd echo what Wayne and Robert basically mentioned. I think what we saw from some of the more institutional guys is they understand the illiquid nature of the markets. And having said that, I think they realize that if they are going to try to get into a larger position, $10, $20 million, $50 million of alternative currency, or something that maybe just isn't in the top 10, well, they're going to slowly, gradually go into that market and build a position that way. That's what we've seen. And really one of the more interesting themes that we saw towards the end of last year with a lot of the funds that we do business with is that they were doing more and more crypto-to-crypto transactions. So in December, our transactions are generally in fiat to crypto. About 26% of all of our transactions were crypto to crypto.
Really?
And so we saw a lot of funds or just our general counterparty base rolling Bitcoin into other types of products. And that's obviously something that we offer at Cumberland. So if someone wanted to trade Litecoin for Ripple, we'll make them that market, which isn't available on any order books.
Interesting. So that to me seems like a significant change, because I didn't realize it was that big of a change. You're saying 20%, 26% of the volume.
Correct. So basically, I think what people started to realize is this idea that you don't have to go into fiat. It would be amazing if you could buy Home Depot stock for IBM. I think that's what people are starting to realize, that this peer-to-peer nature of the technology, well, you can do that in the markets as well. Why couldn't you be able to? And kind of the proliferation of exchanges like Bittrex and Poloniex and Binance kind of break the mold in the traditional thinking of how capital should flow and how you should be able to trade in these markets.
So the one thing, okay, so I want to get to Will real quick, because you guys brought up, I asked a question about what the size trades that are going on there. Is this industry capacity constrained under AUM? So if a lot of traditional capital came into it, can your fund handle it? Can the funds you invest in handle it? Or is it capacity constrained? Is there a certain amount we can only do right now based on liquidity?
Yeah, I certainly think it is capital constrained. I mean, we have a platform product that we're targeting at max 150 million, and that's also just based on our own perception of liquidity and opportunity. I think the headline, and Bobby and others can speak to this probably better than I can, but the headline volume numbers that you read about, I think are very misstated. In terms of there's very little pooled liquidity, so you have to go to an OTC desk to actually essentially get liquidity from several venues simultaneously. There's clearly a lot of reports on wash trading and what % of the total volume that represents. And so I think a combination of actual liquidity combined with the opportunity set does create some capacity constraints, especially if you want to invest in smaller emerging protocols or in dedicated ICO funds or things that are outside of just Bitcoin and some of the larger, more liquid protocols.
So this whole group, including myself, has effectively pivoted our careers to focus on this space. I'm going to ask you, Robert, is this a new asset class? Have we made the right decision, or are we just kind of crazy and llama coins over here?
No, I think it is a new asset class. I mean, I think about this, holistically. I mean, if you look at technology firms, service providers in the Bay Area, which is where I'm from, every single CEO, their top 3 issues, one of them is how do I tokenize my business, how do I leverage blockchain, and I think and we're just at the beginning of that trend, and I think it's going to gain more and more momentum. It really democratizes the whole investment process, access to capital. It's a fundamental shift, I think, and it's here to stay.
So, Bobby, then, based on what, is this liquid venture capital? Does it mash everything together? How do you view this asset class?
Yeah, so just from our counterparty base, the funds are set up very, very differently, right? People trade across different time horizons. People take more of a VC model. People take more of a PE model. And so it just, some are more actively traded. So I think everybody's still trying to figure this out right now. Well, one, the game continues to change. Regulation is still uncertain. Exchanges are running and sometimes not. And so I think people are trying to figure out where this thing goes. But back to your first point, I think everybody in this room can agree that this is an asset class. I think at its peak it was $800 billion. I think today it's right around $400 billion or so. I think, at least for Cumberland, we're here to help grow with the industry and see what comes. But in terms of the career thing, that ship has sailed a long time ago.
All right, good. I was asking for a friend anyways. It wasn't me. Okay, so Wayne, the ship has sailed. You have moved from Morgan Stanley is where you were before into this space.
Yep.
What was the moment that you said, you know what, I got to make this leap?
I guess it happened over a period of time for me. I've always been an advocate of technology, and so I'd followed the progress of blockchain as a technology for the last handful of years. And in fact, I'd used blockchain technology in an old world, like real mining application, like picks and shovels mining, to track and trace parts that were as they sort of they wore out. So I'd sort of learned about the blockchain space, and then I think really. As I sort of came to terms with why I felt there was a real need for tokenization, and originally it was actually from a currency perspective. Like I was asking myself the question: is there really a need for a decentralized sort of currency, and is there a real world application for that? And I came to terms with the fact there are a lot of people around the world who have been affected by poor decisions from the governing bodies, and so that was probably the watershed moment for me from a currency perspective, but I've been sold on the technology a long time before. And since then, I think, as part of Octagon Strategy's business, we see a lot of, primary issuers of ICOs and new projects and whatnot bring ideas to us. I've been fascinated by the way people are leveraging this technology to disrupt and improve processes that are ripe for disruption. It's been a journey.
It's been a journey, I'm sure, for all of us. And the one thing I wanted to hit on with you, Will, is we talked a little bit, I asked the question, is this kind of a mashup of venture capital and investment banking and global macro? When you're out there looking for funds to invest in and at the same time pitching to institutional clients, how do you view this? Is this just everything all together, or is this the skill set that you look for? What do you look for?
The skill set in the managers themselves?
Yeah.
Yeah, I mean, I think we've really been focused on managers that have a deep domain expertise, whether that means they've built companies in blockchain and then now are launching a fund, or they're running dedicated ICO funds, and so they themselves are founders and have a good skill set for evaluating the projects that they're investing in, actually adding value to those teams. And really we look also for that skill set, but also so we can partner with them and provide kind of the kind of institutional and operational background that they just naturally lack, having not run a fund or be kind of in the traditional finance realm. So for us, it's really kind of allows us to create a partnership with these funds. In some cases, you've seen managers partner with someone who has more of a traditional finance background, and that's unique in the fund space. I think it's more just very deep on the tech side. But I guess the other piece that we look for is kind of smaller, more niche focus. So for example, we're investing in a fund that does just privacy coins. And that, again, gives them to kind of focus their bandwidth and time and really having that expertise.
Okay. I want to make sure we leave time for Q&A, but I want to ask each of you, and I'll start with Robert. We've talked about what the space looks like now and how it's changed. This time next year, when we're all back here for this conference, what do you see going forward? What do you think is kind of the biggest change for 2018?
Well, I think that the industry is definitely going to grow. I mean, if you look at the number of funds, institutional funds that are coming into this space, if I talk to our traditional client base, over 50% of them are trading Bitcoin or plan to be trading cryptocurrencies, including Bitcoin. And so I think that the kind of the cat's out of the bag, and I think people are looking for platforms on how to support that growth regulatory-wise, technology-wise. And so I just, I think when we're sitting here next year, there is definitely going to be a lot more institutionalization of the space. And I think there's going to be a ton of momentum. I think one of the things that's interesting is, how centralized or how decentralized things become. Right now a lot of liquidity exists OTC and on centralized exchanges, but there's obviously a lot of decentralized exchanges that are coming to market. And how do you leverage technology to piece that liquidity together, execute in that, and then access it. So I think there's some things I don't know how those things are going to turn out, but I think technology is going to be key to being able to leverage it.
Bobby, what do you think? What do you see coming down the pipe?
I guess I'll pick something very particular. The last stat I saw last week was that 46% of all ICOs that have launched in the past year have already failed. I think that number continues to grow. But at the same time, I think this year, especially probably Q3 and Q4 this year, you'll see some meaningful technologies actually come out and be a minimal viable product. So people will be able to use these technologies and actually now have a benchmark for how all future projects should be fundamentally analyzed, or just at least you have a base case of what these products actually are and the time length to actual investment or participation into these projects and when they'll actually get shipped. So I think this year will be a big year for certain projects to come out and actually go to market.
So an ICO with an actual working product, that would be a refreshing change.
I hope to see one.
Wayne, what do you see happening? Or actually, Will, you wanted to say something.
Well, I was just saying on the institutional flow coming to the space, like clearly it's a macro thesis of ours that that's in fact going to happen. I think as institutions come in, though, they're going to be very discerning on where they actually invest. So I think more liquid currencies or things that are as clear as can be not classified as securities is one area that institutions will invest in. I think the tokenization of existing securities is another space that institutions will feel comfortable investing in because there's a regulatory framework that already sits behind that they know and understand, and some of these businesses also have kind of traditional cash flows that they can analyze just like they've analyzed companies in the past. I think the utility token piece, while I personally think there are utility tokens, I think institutions are going to be slow to appreciate that, and also because the regulatory ambiguity, they're going to be slow to deploy capital in that sub-segment. And so I think the way that flow is circulated within the ecosystem up to this point will actually change quite dramatically when institutions come in. So you've seen a lot of people who have done well on Bitcoin or other main currencies, and they use that to fund a lot of more speculative ICO projects. I don't think institutions will have the same appetite to do that, and so I think you'll see a big shift, and perhaps there will be a couple of these ICOs that do have an MVP, and institutions will be willing to deploy capital there. But I think it's just going to be a smaller subset of the market that will allow that institutions will really put capital to work on, which would be a big change from what we've seen over the last couple of years.
And Wayne, I'll let you enlighten us with what you see happening.
Look, I think this year is all about regulation. And I think more than regulation, I think we should get a lot more regulatory certainty. We kind of view 2017 as being the year of acceptance, and this year as being the year of adoption. And I think that's from an investor perspective, but also from a regulatory perspective. Some of the smaller, more nimble governing bodies around the world have been quite front foot and creative and engaged with the private sector on developing frameworks, right, in which we can operate. And I think, global regulators are working hard, trying to cooperate, and as difficult as that is across borders, I think this year is a year where they'll make a lot of progress. That's one hurdle to really get institutional activity to come to the market in size. But in addition, I think we spoke about earlier, but custody I think is a key thing. And then also from a risk, security, and compliance perspective, that's whether we like it or not, that is particularly meaningful to traditional investors, and they'll be looking for to see progress on all three fronts, be it from exchanges, having the infrastructure support higher volumes. What happens when the exchanges go down? If we have things like indices and we start tracking indices and benchmarking performance to that, where does the liquidity aggregate? We don't have closes, for example, right? The rise of passive managers in equity markets have concentrated all the flow to a close. We don't even have a close. But yeah, I think the regulatory landscape will drive the adoption, and then of course security, risk and compliance will be the things that are really needed before they get involved properly.
So a year of transition, and hopefully this time next year we'll be talking about how all the institutions came in.
Be two unicorns next year.
Yeah. Oh, and llamacorns, yes. So we've got some of the brightest minds up here. We have a few minutes. I wanted to make sure I open it up to Q&A. So I think we have some microphones out there. Is that right? If you have a question, why don't you raise your hand, and they'll bring one over to you. We got one. We have one over there.
Hi, just curious about the trend you're seeing with Singapore Airlines looking to tokenize its air miles at some point this year, and talk about Facebook, Uber, these existing internet companies possibly tokenizing a part of their services. Where do you see investors fitting into that space? Would that be attractive to a VC or a PE fund? What's your take on this trend?
That's an interesting trend. Wayne, you want to take that?
Yeah, I could talk a little bit about that. So as part of the ANX group, part of the business or services that we provide are in fact tokenizing. We've tokenized loyalty points programs already, and I think that particular type of business is ripe for disruption to tokenization. It makes a lot of sense. I think Sing Airlines is one example. Qantas are looking at something similar as well. And in fact, I think Qantas frequent flyer points is one of the most profitable parts of their business. If they can do that more efficiently, I think that's great. And there's been appetite from institutional investors in that loyalty points business for Qantas. I can't see why it wouldn't happen in other parts of the world.
Perfect. We've got a question up here, right in the front. Yeah, there we go. I love it. Making it work.
Earlier this morning, we had a talk on decentralized exchanges. I wanted to hear from the panel what impact you think the successful implementation of decentralized exchanges will have on, or not have on institutional money coming into the crypto space.
I think that's a great one for you, Bobby.
Sure. So I think with decentralized exchanges, it's still TBD. It's too early to tell. I'll just tell you from the institutions that we speak with and just internally how we feel about it is it's very, very novel, very, very new, and it could be groundbreaking. But at the same time, for larger institutions that want to play in that space, there is a level of KYC that needs to happen. So no bank, no firm like ours is going to trade on decentralized exchange that has no level of KYC because you do not know who you are facing off with as a counterparty. Once that changes, which I know certain decentralized exchanges are looking at that kind of channel because they realize that for the institutions to get involved in the decentralized exchange network, they're going to need a layer of that. But having said that, I still think decentralized exchanges are super interesting for retail level traders or players that are looking to enter in that market. But from an institutional standpoint, I think we're still a little bit of ways away as they're still trying to figure out Bitcoin and Ethereum and things like that.
Yeah, just to piggyback on that, I totally agree that institutions themselves won't transact on decentralized exchanges for all the reasons that Bobby mentioned. I do think that the great thing about decentralized exchanges is that it'll preserve the democratization of this space, because while institutions will trade on centralized platforms with liquidity, KYC, AML, et cetera, that's not going to be the venues that the smaller retail traders are going to use, and so it's a nice part of this ecosystem. And in fact, as an investment theme ourselves, there's kind of two areas that we've focused on within the exchanges, is the kind of those that are gearing up to trade security tokens, so think like a T0 or Timberland of the world, and they have that regulatory stack. And then the other end of the spectrum are the decentralized exchanges, because they are they enable kind of the circumvention of some of these, these regulations. So while we won't trade on them directly, it's been an investment theme in our portfolio, and I think that's probably representative of how institutions will approach it.
Great. I think we have time for one more. Another one right up front. Here, grab this.
Thank you, and thank you for an informative panel. We've talked about traditional capital. I would like to, hear your perspective on family offices. We've seen them recently coming through, taking an interest because of the rate of returns that's coming out of these projects. But we've also seen the duration of the decision-making process being incredibly slow, at least 6 months and beyond. How can we actually speed that up? And how can we get them to be involved in, this whole technology and supporting it? And obviously, there are lots of funds there. So
you're saying that the speed of which family offices are making investment decisions you find to be very slow? Okay. Well, if they're slow, then the traditional institutions are like molasses, because at least from the people that we've talked to, those are they're more willing to pull the trigger and invest. I think in part because they don't have this career risk that you have at an endowment, or where they don't really get paid to be a hero and find a great investment decision. You get paid to kind of keep the status quo, where someone in a family office, it's generally their own money or representative of that. In terms of how to speed that up, I would like to know the solution to that just as well as someone who's actively raising capital. I mean, I think part of it is maybe it's some products that have an MVP or more actual applications that they can see tangibly how it's being used. So something like, miles on Qantas, like that's a concept that they're probably already familiar with. And so I guess as you see more of those sorts of use cases and applications, maybe it's easier for them to bridge the gap. I don't know if anyone else does.
Yeah, I'd agree. I'd put family offices amongst the more nimble investment base that we have, and with the long-only community a long way, down the track. I think, again, for all of those institutional investors, though, really they need to get comfortable with the regulatory space, which will allow us to tokenize things that they understand. As Will said, like if REITs can be tokenized, and if all sorts of more real-world applications or things that the older world understands, then I think that the investment will flow faster.
Yeah, and I think there's different ways that family offices are approaching this. I think they're approaching it from an investment perspective in different protocols or teams, and they're able to access those markets, direct investments or funds like Brian and Will's. But at the same time, there are other family offices that say, no, I just want exposure to the coin. And obviously, from the comfort level there's an aspect of custody, which is a hurdle for a lot of people who they're not used to holding their own assets, right? There's no State Street, there's no Bank of New York Mellon that's going to be there and say, hey, we're going to take care of this and handle all the reporting. But maybe that'll start to evolve this year.
Great. I think that's all the time we have. I want to thank the panel for letting us borrow your brains for 30, 40 minutes here. Fantastic. Thank you very much.